1989, Tokyo, Japan. The Nikkei hits a record high. In 8 of the world's 10 largest companies are Japanese. Japan is dominating and America is terrified. Japan's GDP per capita is 10% higher than America's. The Rockefeller Center, an American icon, is owned by the Japanese. And movies like Blade Runner imagine a future ruled by the Japanese. It felt like the rising sun would never set, or so it seemed. In 1990, the Nikkei dropped 38% and lost $2 trillion of market value. And even now, in 2024, Japan's wages have yet to recover to levels seen during the economic miracle. So what went wrong? This is Japan, the setting of the rising sun. To understand Japan's economic miracle, we need to go back to the late 40s. Following its surrender, Japan became partially occupied by the US government, and its economy entered a recession not long after the country was in shambles. Its factories were destroyed, much of its labor force was dead, and trade relations frayed. The US was deeply worried that Japan, like China, would fall into communist arms. To prevent this, they initiated aggressive economic reforms. They dismantled the Saibat system, which concentrated wealth and power among a few families. They reformed land ownership laws, giving ordinary Japanese citizens a stake in the economy. And most importantly, they turned Japan into an export powerhouse. First, by supporting the Korean War effort, then by fueling industrialization with low-interest loans. The results were incredible. From 1953 to 57, exports of Japanese manufactured goods increased by 143%. Compare this to the United States having 51% and the United Kingdom at 31%. But Japan was just getting started. In 1959, low-cost textiles still dominated Japanese exports, with much of this heading to unstable and poor Asian markets. Recognizing this, the Ministry of Trade and Industry launched a new industrial policy, pushing Japan toward high-tech, high-quality manufacturing and stronger trade partners. This marked the beginning of Japan's manufacturing renaissance. Supported by foreign direct investment and a strengthening economy, Japan invested heavily in manufacturing. Given that much of its industrial base was destroyed during World War II, they had to start from scratch, importing world-class technologies to create the most advanced manufacturing footprint in the world. By 1965, Japan had a trade surplus, and by 1970, the country had grown exports by 380%. Thus, Japan became the 5th largest economy on Earth, growing GDP fivefold and eclipsing China, France, the UK, and West Germany. Japan's economy showed no signs of stopping and continued to grow at an average rate of 5% a year for nearly 15 years. The key driver for this was exports. If Japan made it, the world bought it. This helped Japan become extremely wealthy, and Japanese citizens started getting a taste of the finer things in life. In 1978, Louis Vuitton entered Tokyo's Ginza district and quickly became one of their best performing stores. Hermes followed suit in 1979, and by the 80s, Prada and other luxury giants were firmly rooted in Japan. Seeing record sales, Japan was booming. Meanwhile, in the US, companies were kicking and screaming. Between 1980 and 85, the dollar appreciated nearly 50%, putting intense pressure on domestic manufacturing to address this. The US, France, the UK, West Germany, and Japan met and signed the Plaza Accords. The agreement was simple. The Japanese yen needed to depreciate relative to the US dollar, strengthening the American export economy and weakening the surplus that Japan had. Feeling the pressure from their allies, the Japanese had no choice. Within 3 years, the Japanese yen went from 239 yen per dollar to nearly half at 128 yen per dollar. The rapid appreciation of the yen made Japanese goods way more expensive and reduced export demand, softening the overall economy. This triggered a series of events that would lead to Japan's lost decade. To combat a weakening economy, Japan acted swiftly. They cut interest rates to a record low of 2.5%, the lowest in the world at the time, and opened credit markets, making debt more accessible than ever. The impact was immediate. Japan's economy was once an unstoppable force. The stock market soared, real estate prices skyrocketed, and money flowed faster than ever. Citizens and corporations alike dove headfirst into speculation, chasing quick profits with little regard for consequences. It was a financial frenzy fueled by cheap credit, lax regulations, and a deep-rooted belief that Japan's dominance was permanent. Land values surged beyond reason, and unlike traditional real estate investment, no one cared about the buildings or rental income. The land itself became the ultimate asset. Tax laws only amplified this irrational exuberance. Loopholes allowed ordinary citizens to avoid capital gains taxes, while the wealthy sidestepped inheritance taxes. This made land ownership the ultimate financial play. Banks, driven by government encouragement, handed out loans with little scrutiny, using vastly overinflated assets as collateral. It was a house of cards destined to collapse. For years, the Bank of Japan hesitated to intervene, fearing that raising interest rates would stall the country's meteoric rise. But by May 1989, the situation had spiraled out of control. Interest rates climbed from 2.5% to 3.25%, eventually peaking at 6% in August 1990. The shock sent panic through the economy. The final blow came when the Ministry of Finance imposed restrictions on real estate-related loans, causing land prices to plummet as buyers could no longer seek debt to fuel their speculative bets. By the end of 1990, the Nikkei stock index had lost nearly $1 trillion in value, and real estate prices collapsed by another $3 trillion. The economic miracle had come to a screeching halt, and the lost decades had just begun. In the aftermath, Japan faced an unprecedented crisis. Unlike other nations that rebounded from similar downturns, Japan's unique response kept its economy trapped in stagnation. A series of missteps, policy failures, and cultural rigidities ensured that the country never fully recovered. The most devastating consequence of Japan's economic collapse was the banking crisis. When the bubble burst, banks were drowning in bad debt. In a functioning financial system, failing institutions would have collapsed and non-performing loans would have been written off. Instead, the Japanese government allowed struggling banks to keep these toxic assets on their books, creating a class of zombie banks that were technically insolvent but kept alive by sheer denial. For nearly a decade, these institutions continued lending to unprofitable businesses, avoiding much-needed restructuring and dragging the economy into a cycle of inefficiency. Without proper capital reallocation, growth stagnated. The government moved at a glacial pace, hesitant to take decisive action. When public funds were finally injected into the banking sector in 1999, the damage was already done. Even after the bailout, banks continued propping up failing firms rather than allowing market forces to determine winners and losers. By 2002, non-performing loans still exceeded $400 billion, choking any hopes of a real recovery. Making matters worse was Japan's weak fiscal policy. In an attempt to revive the economy, the government rolled out stimulus packages throughout the 1990s. But these efforts were consistently underwhelming. Between 1992 and 1997, only 4.5% of GDP was spent on fiscal stimulus, a fraction of what was necessary to counteract the crisis. Worse still, any economic gains were quickly neutralized by poor policy decisions. In 1997, just as the economy showed early signs of recovery, the government raised the consumption tax from 3% to 5%. This decision shattered consumer confidence, crushed spending, and sent Japan spiraling back into recession. The impact was devastating. GDP growth during the 1990s averaged just 1.4% per year, far below the level needed for a proper rebound. Public works projects also failed to generate meaningful economic activity. Instead of investing in urban centers that drive productivity, the government funneled money into rural infrastructure projects with little long-term benefit. The result was a bloated public sector that absorbed vast amounts of capital without creating sustainable growth. By the early 2000s, Japan had spent billions on stimulus, yet its economy remained stagnant. The combination of zombie banks, mismanaged spending, and counterproductive tax hikes ensured that the country remained stuck in a cycle of low growth and deflation, an economic purgatory from which it has yet to fully escape. Large-scale public works projects were also mismanaged. Instead of investing in urban centers that drive economic activity, the government funneled money into rural infrastructure projects that provided little long-term benefit. The result was wasteful spending that lined political pockets rather than creating meaningful growth. Japan's monetary policy did little to rescue the economy from its downward spiral. By 1995, the Bank of Japan had slashed interest rates rates to zero, but instead of it stimulating growth, the country fell into a liquidity trap. With deflation persisting, wages stagnating, and consumer spending drying up, businesses and households hoarded cash rather than investing or consuming. The cycle of falling prices discouraged economic activity, making it nearly impossible to escape stagnation. When quantitative easing was finally introduced in 2001, it was too little too late. A decade of deflation had already eroded economic dynamism, making recovery an uphill battle. Japan's inability to reignite demand wasn't just a monetary failure. It was a sign of deeper structural issues that kept the economy anchored in the past. One of the biggest barriers to progress was Japan's corporate culture, which actively resisted change. The so-called Iron Triangle, an alliance between banks, businesses, and regulators, protected failing companies by ensuring they had access to cheap loans rather than forcing them to innovate or restructure. This system stifled competition, encouraged inefficiency, and prevented the natural economic evolution seen in other advanced economies. Throughout the 1990s and early 2000s, Japan's productivity growth averaged just 1.2% per year, far behind the 2 to 3% growth rates of the US and Europe. Even in industries like manufacturing and technology, where Japan had once been a global leader, businesses struggled to modernize. Rigid corporate hierarchies prioritized seniority over merit, valued long hours over efficiency, and discouraged risk-taking. Creativity and agility, key drivers of modern economic success, were often sacrificed in favor of tradition and conformity. As global markets evolved, Japan's reluctance to adapt left its industries lagging behind more dynamic competitors. As if these structural inefficiencies weren't enough, Japan's immigration policies further exacerbated its economic struggles. Unlike other nations that embraced foreign workers to offset demographic decline, Japan remained largely closed off. Since 1995, its working-age population has declined by over 10%. And by 2024, more than a quarter of the country's population is over 65. With fewer young workers entering the labor force and no meaningful influx of foreign talent, Japan's ability to sustain economic growth has been severely weakened. This demographic crisis has also created a rigid labor market that makes it difficult for younger workers to find opportunities in high-demand sectors. Senior employees often hold on to positions well past retirement age, limiting upward mobility and leaving younger generations with fewer prospects. At the same time, Japan's reluctance to reform workplace culture has led to an overworked and underpaid labor force, further suppressing productivity and economic dynamism. Despite these challenges, meaningful reform has been slow. Overwork remains deeply ingrained in Japan's corporate culture. Birth rates continue to decline, and there have been no significant immigration reforms to replenish the shrinking workforce. As the global economy shifts and competitors embrace change, Japan remains locked in a cycle of hesitation, nostalgia, and half-hearted policy measures that fail to address its deeper structural problems. Without bold action, the country risks being permanently trapped in a state of economic stagnation, unable to reclaim the momentum that once made it a global powerhouse. Can Japan break free from this economic time loop? The country still has significant strengths: a highly educated workforce, world-class technology, and an unparalleled reputation for craftsmanship. However, without bold reforms in corporate governance, immigration, and labor policies, it risks remaining stuck in a slow decline. Japan's story is a cautionary tale for economies around the world, particularly those riding high on unsustainable growth. The market value of Japanese stocks remains at the same level it was 40 years ago. Wages have stagnated, innovation has slowed, and the population continues to shrink. No developed nation faces a greater combination of economic challenges than Japan. After decades of remarkable expansion leading up to 1989, the government's mismanagement ensured decades of stagnation. They got drunk on low interest rates and aggressive lending without fundamentals. They believed land was the ultimate investment, failing to realize that productive industries drive growth. They funneled resources into inefficient projects, propped up failing companies, and resisted necessary change. Most importantly, they forgot the fundamental rule of economics. Businesses must be allowed to fail for innovation to thrive. Japan needs to wake up. The sun may have set on its economic dominance, but the future is not yet written. The question is, can Japan reclaim its former glory, or is it stuck in an endless economic time loop? Should they open the floodgates to immigration, or is there another way out? Drop your thoughts in the comments. And if you enjoyed this deep dive, don't forget to like, subscribe, and hit that notification bell, because the next economic roller coaster is just around the corner.